Amazon has a thriving cloud business, over 300 million active users, and is one of the largest streaming services in the world. Yet the stock is down over 30% year to date, but that does not include the 9% pop or plus 9% pop after hours. So should we be stepping in to buy the dip on Amazon as the stock is near its 52-week lows? Stick around to find out as we talk about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we're going to take a look at Amazon's Q2 earnings results as the company has just reported, and we'll talk about what this means from a fundamentals perspective as we're coming off the back of a 20-to-1 share stock split and a Q1 that definitely disappointed from Amazon standards. So if you're interested in Amazon, you're in the right place as we're going through the numbers, the top line, the bottom line. We'll also end up talking about how the Q2 worked out for Amazon, whether good or bad, and finally we'll conclude with an evaluation of this business using our intrinsic value calculator on the screen now, and we'll see whether or not this is something we as retail investors should be adding to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we'll be doing this analysis in 5 minutes, so let's jump into it. So for this quarter, Amazon did revenues of $121 billion. They were estimated to do 119, so they beat by $2 billion, and revenues actually ended up growing 7% for the quarter. Their costs on those revenues were actually about $66 billion, so they have to pay about 50% of those revenues to actually produce them. And then when we deduct for our other expenses, we're left with total operating income of $3.3 billion. And if we compare this to the quarter a year ago, we can actually say, yes, we're actually down quite substantially. And actually, it's about 40% decline year over year, which is not good from the bottom line perspective, especially once we get down there. Deduct for our taxes, our unrealized gains and losses, and we're down to a negative income, actually an income loss, and that is of $2 billion for this quarter. Last year, we were at $7.7 billion in profits. So not a good quarter at all from Amazon's perspective. They're trending in the wrong direction, and this is not what you want to see from a huge conglomerate. However, we have to understand the currency challenges that are going on in the current economic environment. There's a lot of that. There's currently a war going on. So it all adds up, and it's the reason why we're seeing a lot of bad quarters across most businesses that we've been analyzing. And when we get down to the bottom line here, we're looking at the diluted earnings per share figure. We came in at negative 20 cents, actually an income loss here of 20 cents per share. They were actually expected to come in just profitable at 12 cents, so that also was a miss. And we are down year over year. So this is going to be a little challenging when it gets to our calculator here. When we have negative numbers, things are not going to look good for the calculator, and I'll tell you that in advance. But before we get there, let's look at our balance sheet just to see what's going on with their financials there. And as you can see, we have cash of about $37.5 billion plus the $23 billion of marketable securities. So let's say they have about $60 billion of cash sitting there on the sidelines for them to play around with. And if we scroll down here to our debt figures, we can see that they have about $60 billion in debt. So their cash to debt ratio is basically even. So that is decent from a balance sheet perspective. They can service their debt at any point, so that is good. It's just that the only thing is, I would want to see if they have $60 billion of cash sitting there on the sidelines, essentially. How can they reward shareholders with that cash? It's just sitting there. It can be used with better things, more investments. And I know Amazon does do this a lot. However, we can see more with the cash reserves that they do have there. Now, onto the statement of cash flows here. We pulled down our net income loss figure. And this is the reason why actually they also included in here the 6 months ended and 12 months ended figures. Because if they had just added the 3 months ended, it would be a very wonky calculation that we'd have. With the 6 months, we can get a better point of view, but it's still negative, as you can see, for the first 2 quarters of 2022 when it comes to their net income. And then for the 12 months ended, this does include 2021 figures here, we are just slightly profitable at $11.6 billion. And I say slightly only because the 2021 figures are definitely propping this figure up here. But let's use this just for our calculation's sake. Okay, as you can see, year over year for a 12 months perspective, yes, it is down, but let's still take this $11.6 billion in net income figure, add in our depreciation, amortization, stock-based comp, etc., etc. We get down to operating free cash flows of about $35 billion. Okay, we deduct our capex figures here of $65 billion, and there goes our free cash flows right out the window. That's why we're at negative free cash flows with Amazon, and we'll see that in just a second when we get to the calculator. So what does any company do when they have negative free cash flows? The typical result is they take out loans from the bank to get some more cash on hand, and that's exactly what Amazon has done. We can see here they took on $23 billion here, paid down $18 billion, but then took another $13 billion here. So with Amazon right now, things are fundamentally not looking amazing right now, especially on the bottom line, and then translating that into the cash flow section of the business. However, historically, we have seen that Amazon has done better, so we have to give them the benefit of the doubt and assume that after the economic hardship we're currently going through, that they can resume to their growth numbers and they can achieve profitability and positive free cash flows. So let's jump into our calculator to see at what price we would be comfortable picking up shares of Amazon for a margin of safety. So as you can see here, Amazon was actually experiencing growth year over year in their earnings per share segment, and then we had this year 2022. So far it is quite low. So analysts now are expecting that we're going to have about 80 cents by the end of the year, and then we're going to return to, in 2023 and onwards, we're going to start growing again and at high numbers. So yeah, let's say that we can do about $2.50, let's say $3 in earnings per share by the year 2023, and that's the number we'll put into our calculator here. So $3 in earnings per share, we require a 10% return. They currently do not pay a dividend. Okay, if they can continue to grow at around 15% on the $3 and then 20% after that, let's actually just drop that down to about 15%. Let's say they can grow for 15% for the next 10 years, and that's what we're going to require from them. On a 20 PE, yeah, they'd be at a fair value of $90 per share, which is a little rich for where they are right now, sitting at 120. And actually, after hours, we're up at $137 per share. Now, if they are to achieve strong growth metrics here, 25% for the first 5 years, and then we can say 20% for the 5 years after that, 25 PE, we're looking at $201 per share for this stock. And I mean, that could be something that comes to fruition, especially with a stock like Amazon. Everybody wants to own a great business like this with over 250 million customers. But in the worst case scenario, we do have to look at this situation as well, which is that they start to slow their growth continuously. And let's say this slows down quite badly from 10% down to 5% on a 15 PE, the stock would be worth $37 and nobody would want to look at it. That is highly unlikely. I don't want you to take this calculation here into consideration too much because it's not really probable that this is going to happen with Amazon. However, it's a part of our calculation here. And as you can see, for our 5-year revenue growth, we've seen 28%. For the 5-year earnings per share growth, we've seen 67%. So even if we bump this up to 50%, let's say they can start growing again at high numbers, 25% for the 5 years after that, assuming growth starts to slow as the business matures, we'd be up to $600 per share. So this is really what the difference is with Amazon, right? It's if they can grow back to those numbers that they were growing at, then we're going to see some significant stock appreciation here. But Amazon definitely needs to get back to their growth, and they need to get back to profitability more importantly, and then that can lead down to more and higher cash flows. And then even later on the line, maybe they want to pay a dividend to reward shareholders even further because they do have a significant amount of cash sitting there on the balance sheet. So that is a possibility in the future, in the long run, but that's obviously not included in our calculation here. It's just speculation at this point. With that being said, that's the risk and reward with Amazon. Can they get back to profitability? If they can, this stock should appreciate quite heavily, and we'll probably see the stock back up into 200s or higher. If the stock cannot grow to those high and lofty numbers, and it starts growing at 5-10% normalized, yeah, the stock is probably going to stick around to where it is right now. But again, that is the risk and reward. It's up to you to make that decision. That is just my analysis. And if you enjoyed the analysis and the value investing perspective, please leave a like and subscribe, and I'll see you on the next one.